My name is Joe Ryan. Nice to meet you guys. Let me just get this so it's projecting onto a different thing. Basically, I own a small little computer programming development shop based out of Minneapolis called Creative Ape Studios. About probably about 8 years ago, my story started. I should have graduated from the University of Minnesota with, you know what, I'm just gonna, because I'm not very good at doing two things at once, we'll just do it this way. I should have graduated about 8 years ago from the University of Minnesota with a Bachelor of Science in computer science, focused in artificial intelligence and robotics. But I decided that I didn't want to be what's called a code monkey, which is a derogatory term for a computer programmer who sits in an office cubicle from 9 to 5. And it really wasn't for me. So what I did instead is I enlisted in the Marine Corps, where they taught me Pashto, which is the language that the Afghans speak. And then I went into, my job was called cryptological linguist, so which is signals intelligence, so basically I went to Afghanistan twice, did a whole bunch of intelligence work that I can't really talk about, just got out a year ago, about a year and a half ago, went to work for Boston Scientific as a project manager, decided again that the office life wasn't for me, and so turned down a job offer from them last July to go help them integrate a new company into their portfolio, and then decided to do this instead. So I'm not a code monkey, I'm a creative ape, which is what I like to call one step above. So what I do is I help small companies or large companies develop apps or other programming things, whatever it may be. I've got some flyers in the back if you guys are interested in that or not. But let's get on to the actual presentation because I don't have very much time. So in my as a side project, I do a bunch of personal investing with all the deployment money that I got because it was all tax-free and it was great. I couldn't spend any of it while I was in Afghanistan. And I came up with this investment algorithm called, what I'm calling it perFactor, which is refactored perception. So basically what it is it's a side project that is turning out really, really well for me, and I'm looking for how do I unlock the value of it for other people, basically is my question. I have no professional finance background, but that's what it is. So most investment algorithms nowadays are what's called high-frequency trading, so it does thousands and thousands of transactions a day. This is not that. This is based on Benjamin Graham and the intelligent investor and Warren Buffett's value investing theory, basically. So we're looking for high-quality companies to hold for not indefinitely, because that's his theory, but more medium to long term. So the target market is to hold it for a year or longer. What it does is it uses the concept of wisdom of the crowds in order to find potential buy things and then to analyze potential buy opportunities within a certain subset of publicly traded companies. And what that means is basically it looks at a bunch of different input factors, averages them, takes out the noise, and then ranks the S&P, and I'll get into the details there in a second. But basically, I'm trying to beat the returns of the S&P 500 over the long term. So that's the overall what I'm trying to do. This is the overview of how it works. Basically, I'm looking for reduced risk companies overall to invest in. So what happens is out of all of the publicly traded companies, I'm only looking at those in the S&P 500. So because I'm trying to beat the S&P 500, I figure we'll just try to find the best ones of there. Further refining it from the S&P 500, I only look at companies that pay a dividend. That's because of some input that I got from someone a couple months ago that generally companies that pay a dividend are safer investments because they have the extra cash on hand, they have whatever. I'm trying to reduce the risk because it's such a long-term investment time period, but also maximize the returns. So then what this algorithm does is of those companies in the S&P 500 that pay a dividend, it ranks them from in the next year, which one is going to have, does it thinks, the highest return. And all of those companies, it ranks it from worst all the way to the best. And then I only invest in the top 20 to help cancel out the noise of no prediction is perfect, basically. So I'm trying to, by doing the top 20, I'm hoping to get the best return, better than the S&P 500, excuse me. So how does it rank it? I use open source intelligence based on a couple of different publicly available websites and the data that is presented on them. And then it looks at a bunch of different factors from it, ranging from the the PE ratio to analyst ratings to the dividend percentage to a whole bunch of other factors that are involved. I'd be willing to go into detail with you guys, but I don't really have time with this, and it's okay. And then it looks at that based on different websites, and then the theory is that some of them might be overestimating, some of them might be underestimating, some of them might be dead wrong. And so by looking at different websites and then sort of averaging out the different recommendations for the different stocks, hopefully that noise is canceled out and then the prediction will be more accurate. The theory there comes from, I think, the early 1900s. There was a county fair in Philadelphia, I believe. I might be getting the details wrong. But basically, they asked a whole bunch of farmers how much a cow weighed. And they asked like 800 different people, and the answers ranged from 5 pounds to 1 million pounds, all over the whole thing. But overall, at the end, they averaged everyone's answers, and then it was within 1% of the actual weight. So that's the theory that I'm trying to do with this. Wisdom of the crowds. So this is what it looks like, a graphical representation. Well, from March 15th is when I was putting these slides together, so that's the date I used for this graph. But basically, this is every single company in the subset of the S&P 500 that I'm looking at, and it's ranking them based on the wisdom of the crowds, the other things, or whatever. So this blue line here means it's a hold. This 1.0 is a strong buy, and -1 is like, get rid of it right now. This blue line here is how much perFactor ranks it as what is the expected return within the next year of some time. From this one here is 100% roughly. Most of them you'll see are down here in the 10 to 20%. And then these ones here are below. And then this one here is an outlier, which it said sell it right now and you're going to lose 100% of your money. So basically what I'm looking for in the top 4% of the S&P 500 is basically I'm trying to find the highest return with the least risk, I want to call it. Oh, is that not working? Yeah. So I kind of have a loud voice, so I couldn't tell. So basically what I'm doing is I rank all of these companies using that same algorithm or whatever, and then I invest in 20, let's say a day, or whatever the extended time period is. Because I want to avoid accidental market timing. As I'll show you in this next slide, is if you invest all of your money at one time, you could just based on the nuances of the market, your returns won't be as much as it could be. And so in order to further reduce risk, I like to invest over a predetermined purchase schedule. And I've done this, and I'll show you this in the next slide with my own personal money. And then I'll show you the returns that I'm getting right now. And also to avoid unnecessary taxes, it's just you want to invest for approximately more than a year based on how it's working now. And it looks like I'm running out of time, so I'll show you this. So basically what I did is I invested equal amounts on 3 different dates using 2 different algorithms because I'm actually A/B testing this right now. So the reduced risk, I've got, so here's how this works. This is how much the S&P has returned on that date. This is how much my algorithms have returned since that date. And then this is how much better I've done than that. So basically, out of all 6 of these, if you average it for based on, basically just averaged how much was invested, the S&P has averaged 6.6 since I invested my money, but I've gotten, using my reduced risk one, I've gotten 12.9, which is 195% better than the S&P, and then with the what I'm calling the beer goggles, because you take on more risk when you're drunk, I've gotten 15% versus 6.6, which is 227 times better than the S&P. Now, granted, I haven't been doing this very long, but I believe in it enough to, 1, invest my own money, and 2, to figure out what to do with this and ask you guys for advice. I do have some sell criteria because you always need to have a hard deadline of when to dump losers or take profits or whatever. Basically, if it goes bad within the first year, get rid of it and reinvest it in a better one. And if it's longer than 1 year, if it's out of the top 15%, because I want to invest in top 4, then basically switch to the better stock. And so that goes to the last slide that I have. What do I do with this? This is my question for you. I'm not a professional finance guy. I did this on the side. This isn't even my primary business. I do software programming. So I'm looking for ideas on how to unlock the value of this algorithm for others. Thank you.
given that you're pulling a lot of your information from near real-time information on the web, is there a way for you to back test this? To go back? How's it?
Yeah, absolutely. So the question was if I could go back a year. So no, because I didn't have the information a year ago. I only have the dates that I've run it, which is approximately, since January 31st, I've run it approximately once every 3 or 4 days or so. So I could back test it to those days, but because the information is not financial information, it's based on the open source intelligence of the websites, it's, I don't have a snapshot of the websites from the past, so I can't back test it. So I know that that's a common test for algorithms, but I do not have that information. Yes? Well, I'm not. That's my question for today. I don't know. From my understanding of how this works in the professional world, which it granted is pretty limited, it's usually a percentage of returns or something. I honestly don't know what would be a fair market value to charge for this. That's my question. What would you recommend? I mean, I know this is not legal advice. I'm not going to hold you to it, but yeah.
I'd say basically you've got maybe 3 choices. You've got to decide whether you want to be a registered investment advisor or perhaps team up with someone and start your own hedge fund, which you wouldn't be under as much scrutiny, or somehow sell your information to investment advisors. Don't be one yourself somehow, only go to them with some sort of a copyrighted monthly thing, and they can use your something. But what you don't want to do is get tied up in too much legal rigmarole, especially if you're doing stuff that is rather unique to you. I guess you stay away from the SEC if you can.
Thank you. Yes. You want I have actually, by Nicole Nassim Talib, yeah.
And what your intentions are and the assessments on that those black you can sell it to prosperity. If you're trying to pitch that offering, you got to have an understanding of what the downside is.
Fair enough. That's good advice. Thank you. I know my question was very vague, but does anyone else have any questions about how it works or anything, or any other insight?
Yeah. Are you using the Esther database in your publicly?
Maybe. No, that's fair. Basically, if it's online and it's free and it's one of the top, let's say 10 places that people go on the internet for investment or money data, I'm probably using it. Okay. just the pure financials. All right, thank you. Since you're close, I'll just give you this.
In terms of the business model, could it be something like you have a website, but people pay, say, some subscription fee? Like, say, I don't know, if your information were good, I'd pay you $100 to get your weekly stock picks, that kind of thing.
I'm used to yelling at Marines in loud voices in large groups. So I did think about that, doing it published a weekly or a daily or something. I also thought about opening up an API access to people programming, or who are doing the quant analysis, I guess. But I guess, I don't know, I'd have to talk to a lawyer, I think, about that, because I believe that there's quite a bit more oversight if you're releasing the information than just investing with it or doing, I don't know. This is not my field of expertise. Yes? Oh, yeah. Yeah, that's a good idea. I mean, that's primarily what I do, actually, for my primary business, is help people develop basically bring their ideas into reality in terms of code. So, yeah, I think I'm going to look into that. Thank you. Sure. Yeah, absolutely. Yeah, I'll talk to you afterwards. All right, well, that looks just about everything. Thank you very much.